you on the map. This is Ron Costa broadcasting live in the Mappable USA studios in Las Vegas, Nevada. And today, folks, we're going to be talking about a really interesting tax strategy for real estate investors. And before we get into that, let's introduce Vicki Hutchmala from the World Token Market. Vicki, how are you doing today?
I'm doing good, Ron. I'm doing better now that the sun finally came up. You know, I was kind of confused this morning. When the sun's not up, when you wake up in Vegas, then there's something wrong. So, but nevertheless,
that's right. It's never be cloudy in Vegas.
Yeah, we have an outstanding guest today on our podcast. We're going to talk about cost segregation, something that people maybe don't know about, but how it can really help you in your real estate investing. And we have an expert as a guest today on our podcast. So can't wait. Yeah. Let's go.
Let's get this going. Okay, folks, let's meet Yonah Weiss. Yonah's the business director of Madison Specs. Yonah, how are you doing today?
I am doing wonderfully. Thanks so much for having me. Great to be joining you guys.
Our pleasure.
Absolutely. Yeah, it's really our pleasure. Yonah, we saw you on a webinar a while back on one of our favorite guys, Neil Bauer, and you gave out so many good, interesting information on this topic. We had to get you on because it's something that I think a lot of investors have to know about and they don't. So before we get started, let's talk about you a little bit. Can you give us a little background on yourself and how you kind of got into this whole industry?
Sure, yeah, and I appreciate you guys having me on. I've been in the real estate business for about 5 years, not so long. My background is really in teaching. I was an educator for about 15 years, and that's really my passion more than anything. But real estate is just, I have fallen in love with it and so many aspects about it, especially the people, the community, and the potential for wealth creation. This company I work for currently, Madison Specs, been here for about 3.5 years, and I have really found a niche in this space of cost segregation, and I found that people just don't know what it is. So I took my background in teaching, my love for helping people, and as a business development, a business director, just trying to spread the word and trying to teach as many people about this subject, because I found that the reason people don't do it is simply because they don't know about it. And knowledge is power. And so that's really what I'm here for.
Great. And Madison Specs, they are a full-service company?
So we're the largest national cost segregation company. We're not an accounting firm. We're part of a larger commercial real estate servicing company. We do national commercial title agents, we do 1031 exchanges, due diligence, and a number of other services for commercial real estate.
Yeah, everyone loves investing in real estate. No one likes paying taxes. So this is the conversation to have, right?
So,
exactly.
Yonah, how did you figure out cost segregation? And I mean, I would assume that it's part of the tax code, just one of those little in the fine print. But how did you first discover it, and why is it so wonderful? Kind of give our listeners a little bit of a in-depth kind of explanation of what it is.
Well, I found out about it really with this company. They were doing it. I didn't come into the company knowing that this was going to be my my passion or my area of expertise, but I found since there was such a need for it, I literally just learned from the experts that are on the team that have been doing this for decades, and just sat with them for months and months just studying it, and until I really got a hold of it. And I found that really the most important part of this is that taxes, especially income tax, is the biggest expense that any business or individual is faced with. And here's a strategy that a lot of people don't really know about, especially accountants don't even know about, and leaving a lot of money on the table. And it's a way for people who invest in real estate to literally pay little to no income tax. And so that's really what's sparked interest in me. It's like, wow, this is something that so many people can benefit from, and they don't know about it. There's got to be a way to get the word out and spread this to a wider audience.
Oh, well, that's what we do, inform and educate our listeners on new concepts and concepts that can help them individually and through their business. So this is great. So explain to our listeners what cost segregation is.
It's a form of depreciation. Okay, so depreciation is a tax deduction, probably the greatest thing. When you hear about real estate investing that has tax benefits over any other type of investment vehicle, it's really depreciation. And so cost segregation is an advanced form of that. And it allows you to take larger depreciation deductions in the earlier years of owning a property. So I'll break it down pretty simply because the name is weird, right?
Right.
It's cost segregation. So when you buy a property, you literally get to take the depreciation deduction, and this is a deduction based on the concept that things go down in value as time goes on. And what this does, depreciation, you're allowed to literally take the building value as an income tax write-off. Okay, literally. So you buy a building for $1 million, you can literally take $1 million tax write-off. But you can't do it all at once. It has to be done over a long period of time, over a 27.5-year period specifically for residential properties, or a 39-year period for commercial properties. So that's a little bit, about a $20,000, $30,000 tax deduction every year. And it's really interesting is cost segregation. What we do is we segregate the cost of that building into shorter depreciation lives, which can actually get you bigger tax deductions in the earlier years. So in just a quick recap of that, it's a way to take huge tax deductions in the early years of ownership instead of having to wait 30 years or 40 years to take a little bit of deductions every single year.
Can you do it in categories? I mean, how does that work as far as like taking that segregation into a smaller kind of a pool, I guess, is what you're talking about, right? How does that work?
Yeah, so it's basically segregating the cost of the building. So the building and the structure of the building actually is the only thing that's supposed to be depreciated over that long period of time, over that 27 to 39-year period I mentioned. But there are things in the property that you're supposed to depreciate or take the tax deduction of those components of the building at a faster rate. So things like furniture and appliances and carpeting and cabinets and all kinds of other things you're supposed to take as a tax write-off over a 5-year period, which means you can take huge tax deductions in the first 5 years of ownership. But you need to do the cost segregation study, this engineer-based report, to identify what those objects, what those items are, in order to take the tax deductions of the value of those items.
Well, so you have the real estate, and whatever improvements onto the real estate is one category, and you segregate that from the inside, like tangible enhancements to the capital investment, and then that becomes a group, and combined you can depreciate over different times at different amounts. Am I confused, or is that what it is?
No, you're right. That's exactly right.
Oh, okay. So a person who wants to use this strategy, then, like you said, gets reading or a report that separates those two different categories, and then you help them work it out. So now, in this depreciation, especially with the inside items, can you purchase new furniture and purchase new stuff and increase your depreciation in this cost segregation concept?
Yeah, you can buy more things, and you can get be able to depreciate the value of those items that you purchase, and you depreciate. So basically, as I mentioned before, when you buy a building, you're now taking that entire value and depreciating that over a long period of time. And that doesn't change if you do a refinance or you get an appraisal at a higher value. It stays the same when you buy your property. Okay, that's your tax basis. That's the amount you can take as depreciation. However, when you add more stuff into the building, you buy, replace the appliances, for example, or the carpeting or whatever, all of that is now depreciated as well. So you need to properly allocate that to those faster lives, but do a follow-up cost segregation study on that.
Oh, okay. So that's really very interesting, because it's not just the things that you do to the building or the real estate that become permanent. It's just anything that enhances the operation. Wow, that's pretty special.
Yeah.
Yeah.
So,
And now you mentioned something about an engineer. Do you have to hire an engineer to determine what these values are?
Yeah, that's right. So part of the thing why accountants don't do this or don't know about it is because it requires this engineering component to it to identify what those items are and what the value of them is. Because when you're building a property, when you're developing a new building, it's very easy to know what the cost of things are because you have invoices, you know how much you spent on the cabinets and the carpeting, et cetera. But when you're buying a building and you are kind of having to reverse engineer how much are the value of these cabinets that have been in there for a number of years, and this building I bought for $1 million, but it was built 10 years ago or 20 years ago. How do you go and reverse engineer that? That's what the job of the engineers are, to kind of make these calculations to identify what all the individual assets are and how they depreciate going forward. Because again, that depreciation schedule, that 39 years or 27 years starts the day you buy the property, even though the property was really built 20 years ago.
Okay, so if I have a property and I've been depreciating it on my income tax, and I've been doing this for, let's say, 5 years now, can I kind of jump into this thing now after being an owner for 5 years?
Yeah, you can actually go back and without having to amend your tax returns, you can catch up any depreciation that you missed. So if you actually, were just doing what's called straight line depreciation and just taking those regular deductions each year and you didn't do the cost segregation, you can retroactively catch up all the accelerated depreciation that you could have taken over those past 5 years.
Well, that's certainly amazing for like a homeowner, for a residential homeowner. But I guess if you're talking about maybe like a big-time real estate developer, commercial buildings and multifamily, that probably adds up to a significant amount of money, don't you think? I mean, really a lot of money.
Yeah, absolutely.
Wow, that's really okay. Now, from these engineers' perspective, how do you get to be an engineer? Are these guys all of a sudden they just claim that they're engineers? Is there a degree that they have? Are they certified somehow?
There isn't a specific qualification or certification for this, but it really has to do with the experience. They have to have experience in construction engineering as well as the knowledge of the tax code, which really is what it's all about. There's what's called the MACRIS, the Modified Accelerated Cost Recovery System, which is the system in which the IRS determines how much each individual item in a property depreciates, how fast it does. So they have to be very well versed in that to break down that. So there's not a specific, again, to answer your question, not a specific qualification, but it really comes with the experience.
That's interesting because a lot of times in real estate, as you know, a lot of these appraisal guys are out there, and if you talk to 3 different appraisers, they may come back with 3 different values, and obviously you take the one that works best for whatever your goal is. I guess it would be the same over here, right? Would you work with just one engineer, or would you work with a number of them and kind of take the best numbers that you think would work best for you?
So we have engineers on staff in-house that they are, they're trained in this, and so it's. I think every firm, employs the same kind of strategy, the same methodology, and so they need to have the experience and the knowledge of the tax code specifically and of the construction engineering. So yeah, most of our engineers have a background in building or construction engineering, but again, they're trained in the taxes.
How do you?
So they're not actual. They're not. I'm sorry, Ron. They're not engineers per se, as in they have a degree in engineering. They're just persons with considerable experience in order to be trained to focus on this kind of tax advantage.
That's pretty accurate. Although many of them do have engineering degrees, but yeah, that's accurate.
Oh, okay. I'm sorry, Ron. I didn't mean to interrupt you.
Oh, that's okay. I was going to say, how do you indicate this to the IRS? Is there separate forms, or is it just a straight line depreciation like you normally do?
So it's really what we do is this whole report that we create, all it does is create a new depreciation schedule. So an updated depreciation schedule that's broken down in different categories at faster rates. So that's what the IRS, that's what you're going to apply to your tax return, that one page out of this 100-page report that we create.
Okay. Are most of your clients right now that are doing this, are they mostly commercial developers, commercial real estate people, or is it more residential, or kind of mix of both?
It's a mix of both. This does not apply to your personal residence, but there are plenty of people that are investing in single family or multifamily projects that are taking advantage of this.
Oh, interesting. Yeah. There's when it comes to real estate, there's different vehicles that you can use. You can use opportunity zones to help with your capital gains investing, and you can use 1031s for real estate. Is cost segregation just an enhancement to those other plans, or is it its own separate? You do this, or you do this, or what? How does it work together?
That's a great question. They can work together. Oftentimes, they are definitely enhancers of one another. What the cost segregation specifically deals with is, the depreciation, and so it's a specific tax deduction from your income tax. Whereas the opportunity zone is oftentimes a way to defer capital gains tax and things like that. So, but they definitely can work hand in hand.
Oh, so it's all in what you do with the property that you're investing in and which one is going to work the best for you, but it appears that cost segregation will help you regardless of what you own or invested in or how you're using that property. It's to your benefit to understand cost segregation and use it.
Yeah, that's right. That's correct.
Yeah, I feel like this is a really interesting topic because I know, well, I don't know this for sure, but I bet you if I go to a number of CPAs, they probably would never even realize this is even out there. I certainly wouldn't be experts in it like you are. Why do you think that is? I mean, don't you think that this should be something that should be on everybody's table?
Yeah, that seems
it's interesting.
I think weird.
It is weird. Believe it or not, I have been bothered by this for a very long time. I've kind of gotten used to the fact, but one thing that I have noticed is that if a CPA is not specializing in real estate, oftentimes they're overlooking a lot of the advantages that come with real estate. And the tax code is huge. I mean, you can't expect every CPA to be an expert in every area of the tax code, and especially when it comes to a specialized service like this, which requires a third-party service, meaning accountants can't do this on their own. It requires the engineering component to this, so they can't necessarily be expected to be on top of it. That, and coupled with the fact that believe it or not, I love accountants. So a lot of them, I have a lot of friends who are accountants. I work with them, but there's a big difference between an accountant and a tax strategist. Okay, and they can be the same person, but oftentimes are not. Oftentimes, accountants are just punching numbers. They are, plugging in, filling those lines, and making sure to do those reporting properly, filling tax forms. Whereas a tax strategist is someone who is going to be proactive to try to find as many deductions as possible, to try to find ways and strategies to lower your taxable liability. So I do want to point that out. That's a huge, so that's probably why there is such a big difference and why accountants aren't pointing this out.
Well, that would make sense. I mean, it's just like an attorney. If you want a divorce, you're not going to go to a real estate attorney. And if you don't pick the right one to help you with what you're doing, well, then you can put yourself in a world of trouble. And
exactly.
Picking the right one will, be to your benefit. If you've got a tax strategist helping you regardless of what you're doing, whether you're investing in real estate or whether you're just taking care of your personal business, strategy is always going to help you better than whoever's cheaper. which a lot of people tend to do. Well, let's go with this guy because he's more affordable, but then you always get what you pay for, and sometimes it's better to go with the expensive guys.
Yep, that's true.
Yeah. Hey, Yonah, are there any specific real estate asset classes that this works better for or worse for? Or is it just a case-by-case kind of thing?
No, there are. There are very specific types of asset classes that work better for this. I'd say the biggest ones in my mind, which is an interesting part of this, are mobile home parks, RV parks, and golf courses. Because all of those have something, all those three have something in common, which is that they are the majority of the property that you're purchasing is actually what's considered land improvements. Now, land, by definition, doesn't depreciate, and you always have to subtract a certain amount from your purchase to allocate to land, which does not depreciate. However, land improvements, what's on top of the land, actually depreciates on a 15-year schedule. So all the concrete in a mobile home park, right, the pads under each home, or an RV park, which oftentimes is just a paved area, and a golf course, which is all landscaping for the most part, all of that is considered to be depreciating on a 15-year schedule, which means you can accelerate 60, 70, 80% of your purchase price into that faster depreciation.
Oh, wow. Well, so it basically has to do with the more land you have compared to the bigger the building on the land.
Right, and very much depending on the land improvements involved as well.
Oh, okay. That's interesting.
It is. And what's more interesting is the last time I played golf, I hit my ball into a mobile home park.
I don't think that was part of the plan, Ron.
It wasn't part of the plan. No, it wasn't. But the last thing I want to go over here, Yonah, is we talked about this whole project now, this whole program really, and it seems like it's all full of positives. Are there any downsides to this at all?
There are some downsides. One of the biggest downsides is when you sell a property, you're subject to a tax called depreciation recapture tax. Okay, so that means you have to actually pay a tax on the amount of depreciation that you've taken during the course of ownership. Now, if you've taken a large amount, if you've taken a large amount of depreciation because you're doing the cost segregation, then you're going to, be hit with a larger tax bill. So that's something that definitely is considered, and obviously you have to strategize properly around that as well, because again, you are, going to have to figure out ways like cost segregation or other strategies to create more deductions to offset that later on. So it's not something that is necessarily bad, but it's something you have to deal with as part of your strategy.
Yeah.
So is this a good concept for a real estate developer, say a major home builder or somebody doing projects that they aren't going to actually own at the end of their work? Is this a good thing for them, or is it more for those companies or those individuals who specifically are investing in specific real estate to own for a period of time?
So it's specifically for rental property. So if you just develop a property and sell it, then you are not going to be getting that depreciation deduction. Right. You don't get the depreciation deduction because essentially you are just transacting, and that transaction is not rental property, and so rental property is where you get the depreciation deduction.
Oh, okay.
And then lastly, do you see any kind of changes down the road politically that may impact this program one way or the other?
It's a loaded question. I don't know, and I think no one knows. That's the truth. I don't know if anyone really knows what's going on because there's too much up in the air right now.
Yeah, that's for sure.
True.
No question about that.
That's a true fact.
So okay, well, this is really good stuff. I know we got a lot of real estate investors on the podcast. They listen to this, and I'll bet you a lot. We're in Vegas, we do betting. I bet you a lot of people have never heard of this. So this is a really great concept. Vicki, what do you think about this?
Oh, I think it's fabulous, and like you say, Ron, if you don't know about it, you can't take advantage of it, and this is an opportunity to understand it. And if your CPA or whoever your tax strategist is that's working with you, you need to tell them about it so that they can help you. And Yonah seems to have made this his life's work to educate and help people understand this. This is great. This is really one of those things that come along that you've never heard of, but oh my God, it could change your life. Well,
That's
relatively.
Right.
Yeah.
Hey, Yonah, if somebody needs more help in this, or if they have questions or want to get a hold of you, or what's the best way they can do that?
Best way to find me, you can go to yonaHweiss.com, which is my website. You can find me on LinkedIn. I'm very active on LinkedIn. And, feel free to reach out.
Excellent. Yeah, and like always, we'll put all this stuff in the show notes for you people who are listening to this, and you see it right on whatever page you're at right now. So, Yonah, thanks so much for being a guest on the show today. We really appreciate your time. I know you're very busy and you do a lot of these webinars, podcasts. So thanks for taking the time out of your day today. Appreciate it.
My pleasure. Thank you guys for having me.
Yeah, it was great.
Yeah, thanks for co-hosting the podcast. And folks, you're listening to the Mappable USA podcast at mappableusa.com. Go to that website, scroll down on the homepage. You'll see all our syndication sources. You can pick the one you like best, subscribe, and you'll never miss another episode. If you want to be a guest on the show, like Yonah was today, there's a guest tab. Click on that, fill it out. We'll see what we can do about getting you on the show. And if you like what you heard today, send us an email, info@mappableusa.com, or just leave a comment on whatever page you're listening to this on right now. So thanks a lot for listening. Thanks for your support. We'll be back to you next week with another Mappable USA podcast. Thanks for listening, everyone. Have a great week.